So on our next session is on corporate taxation by Mr. Gaurav Singhal, Director, Heads Up Consulting. Mr. Singhal has an experience of 19 plus years specializing in corporate and international taxation. He has worked for more than a decade with organizations such as BMR Associates, KPMG, and EY. Good evening, sir. A very heartiest welcome to you.
Good evening. How did you?
I'm good, sir. How are you?
Thanks.
Good.
Thanks. It's a pleasure. Ridhima, I would need the rights for screen sharing. Right now, I'm trying to do that and saying that I can't. Can you please look into that?
Sir, you just try again because earlier maybe a PPT was running. That's why, because there must be a problem. Just try it once more time. Just give me a moment. I'll contact my technology team on that.
Sir, we can run your PPT if you want.
Sure. Just make it full screen so that we can use the entire real estate to our advantage. Just do an F5.
So, ma'am, F5. Just press F5 or a slideshow option must be there.
Yeah, I'm trying, but it is not working. Please wait.
Yeah.
The rightmost bottom corner will also do. Yes, this is perfect. So hello everybody. We will talk about the changes which have been proposed by the Finance Bill 2022 to the provisions which pertain to corporate taxation. Now, corporate taxation is a very broad expression. So to be very specific, we will deal with this agenda. Next slide, please. Yes. So these are the provisions which deal with those expenses which are otherwise prohibited by law. Section 37 is the relevant section which already sort of prohibits the deduction for the same, but there has been a tweaking done. And it's interesting because it will have a lot of implications, repercussions. We'll talk about that. The second part will be the deductibility of education cess on income tax when computing the taxable income on which you pay income tax. So this is a bit of a circular reference. And that was perhaps one of the reasons why the revenue has always been against this position. The taxpayers, frankly, also woke up to this position after some of the beneficial High Court decisions. And now that is something on which the revenue has plugged the position through a legislative amendment. The third one is pertaining to the deduction for interest expenditure when you're supposed to make the payments to banks, to NBFCs, or for that matter to non-deposit taking NBFCs. There the interest is deductible only on cash payment basis, but there has been some litigation around what to do when this has been converted into debentures. Is it constructive payment or not? And that again is something on which the revenue has had its say, and legislature has taken an ear to them and given that amendment to them. The fourth one is actually a beneficial amendment, a small one, but a beneficial one, because of the pandemic. A lot of businesses which wanted to start the manufacturing, their manufacturing operations and benefit from the lower 15% tax rate, they couldn't. So the date has been extended. We'll talk about a change in the process in which TDS, in case of net of tax contracts, can be sought as a refund back from the tax authorities by the deductor. Some small change by virtue of the last year's amendment on as regards non-deductibility or non-depreciability of goodwill. And lastly, change in perhaps the last provision, one of the last set of provisions in the income tax law, which is a reporting requirement, but interesting repercussions, really interesting repercussions. In past, it used to be only relevant for film producers, but now it's going to be relevant for a lot many more people. And that might include even the YouTube influencers, God knows, and that's what we'll discuss about. Next slide, please. Next slide, please. I really wish I had the control for these slides, but it seems to be. Yes, thank you, thanks. The one after that, thanks. Yes, the next slide, please. Thank you. Presently, section 37, which is usually called the residual section, which tells us that you can claim deduction for any expenditure which has been incurred for the purpose of the business, wholly and exclusively, of course, so long as it's a revenue expenditure, it's not a penal expenditure. Back in 1998, an amendment was made there too, which said that, look, you cannot claim deduction for those expenses which have been incurred for a purpose, which are an offense, which is an expenditure which is prohibited by law, right? Fair enough. But then there was some litigation around it, which basically was around various angles. One of them was, for instance, when you're talking about prohibited by law, which law? Indian law or does that also include a foreign law? For instance, where there's a class action suit outside India, would that also be covered or not? Where there's a penalty paid under the European Union, regs, will that be deductible or not? That was one set of controversy. A bigger controversy was, what about what about those expenses which are incurred to give freebies to those kinds of professionals, for instance, medical professionals, when the regulations governing them do not permit such kind of freebies, right? So and mind you, this is something which gained a life of its own. A lot of decisions for and against this matter came out. The revenue was consistently taking the position that, look, all these expenses are also expenses which are for offense, which are also prohibited by law, and therefore the word law should be probably interpreted a bit widely to include even these kinds of guidelines. And therefore, to sort of give clarity on this account, because there were a lot of decisions which came out favoring the taxpayers. Now the budget proposal says that, look, we are now clarifying that all these expenses will also be disallowed. Which expenses? All those expenses which have been incurred, which are relating to any offense or prohibition, whether they are in relation to a law outside India or in India, both. Secondly, even if you have got some offense compounded, right? So the compounding expenditure that you have incurred, even that will be not allowed. And third one, that gives an opening to a wider interpretation to the word law, because it says that when a businessman is providing, when a company is providing any benefits or perquisites to any person, right? Medical professional is just an example, but to any person, and providing that benefit or perquisite violates any rule, any regulation, or any guideline governing these people, then because there's a violation still of some kind of a wider expression of law, even these kinds of expenses will also be disallowed. And I heard with a very keen ear the discussion which you had a little while back about the meaning of the word benefits or perquisites. There's a gentleman who referred to the Mahindra and Mahindra decision of the Honorable Supreme Court, saying that, look, it should only be in kind. And it will be interesting because what's the meaning of the word benefit is going to have several repercussions at several places, about 194R on one hand, and maybe here as well. And therefore, the question will be that, is it only the in-kind benefits that you're giving, or something else also which will not be covered here? But yes, perhaps the intention here is to cover the in-kind benefits. The expenditure on those in-kind benefits will also be disallowed. Now, easier said than done. There are a lot of questions which crop up. Firstly and foremost, this whole thing started from 1998. Back in 98, the memorandum explaining the provisions of the finance bill, and I'm not reproduce it here, but fundamentally speaking, the kind of expenses that were sought to be targeted when this amendment was made, that, look, no deduction for expenses on prohibitions. It gave the examples of extortion fees. It gave the example of hafta. From there, we have traveled all this place to, expenses incurred outside India, prohibitions outside India, compounding of an offense, which I think is a lighter shade in comparison, and maybe a few more steps, not just steps, actually miles beyond it, miles from extortion and hafta, where we are talking about benefits of perquisites. So this has traveled a long distance, and therefore it will have a lot of repercussions. Even these amendments will have some repercussions. Let's think about them. Next slide, please. Firstly, what we are saying is that an Indian businessman is now expected to be aware about the laws outside India. And I know, the principle is that ignorance of law is no excuse, but that is about the ignorance of the law of your state, because ignorance of law of foreign state is sometimes considered by some of the courts to be a mistake of fact, as against a mistake of law. And not just that, businessmen are now expected to be aware of guidelines as well. Now, what do you mean by guidelines? Are we saying only guidelines created by statute? Not really, because then we could have simply used the word act, right? Guidelines could be created by institutions which govern us. ICAI governs me, but it doesn't say that either. It just simply used the word guideline. So are we saying that if we have incurred some expenditure, if a businessman has incurred some expenditure on giving a gift to an employee of a business associate, and he doesn't know whether or not the internal policy of that company of which this employee has received the gift, does it or does it not prohibit receiving such gifts, right? And most of the clients that we see, most of the good responsible clients have FCPA related regulations. no gifts at all. But are we saying that now the businessman is expected to be aware of these? And guidelines, will they be only the ones which are in India or the ones outside India? Because that part is still left open, interestingly. And, guidelines is a very wide expression. We might think that, we are aware of it. I'm just giving an example here. One of my team member, an extremely diligent one, told me that Gaurav, Hollywood Foreign Press Association, these are the guys who run the Golden Globe Awards, right? They have a guideline which prohibits the members to take freebies. So just imagine you have engaged these services of one of the, one of the topmost of, one of the most brilliant Hollywood performer, one of the most brilliant Hollywood celebrity. And there, when you welcome that person, you probably gave him genuinely out of courtesy a gift. Now, God forbid, are you going to be going and checking out that is he or is he not a member of Hollywood Foreign Press Association? Because we are probably not talking about big gifts. So if assume you have heard the services of Nicolas Cage, and Volkswagen Finance did that. They got an unfavorable order from ITAT Mumbai on a different count also. And you are not gifting the national treasure to Nicolas Cage, but instead all you're gifting him is a little bunny that he can take home to his daughter. Would that also be a freebie? So where does it stop? Next slide, please. So these kinds of questions will come up as regards the amendment to 37. Now we are moving on to the next amendment. This amendment has been made to section 40. Now, section 40 contains a list of all those expenses which are not deducted. One of those expenses is taxes themselves. Taxes which are on levies, which are computed with reference to the profits or gains. Those are not deductible, which essentially means income tax is not deductible in computing the taxable income on which the income tax has to be paid, right? Now, whether the term taxes includes education cess or not somehow became a very interesting, litigation issue in the last few years. Now, why that happened is because suddenly somebody was able to obtain some favorable decisions, for instance, Rajasthan High Court Cessa decision and so on and so forth, where it was held that, education cess, it's a cess. And there's an old CBDT circular, although it pertained to a different kind of a cess. Back then, there was no education cess. Education cess came into existence around about 2005. So that old CBDT circular said that, cesses are deductible, although it meant to say that for a different kind of cess. But since the CBDT circular said it, the taxpayer was able to successfully convince the court in that matter that, look, since the CBDT circular said it, it's binding upon the assessing officer. We deserve this deduction, and he got some favorable decision. And then came a lot of similar other favorable decisions, saying that yes, education cess, which is computed on income tax plus surcharge, is in turn deductible in computing the taxable income. And there are some negative decisions as well, ITT Calcutta being one of the recent ones. And it's also quoted in the memorandum explaining the provisions of finance bill pertaining to this very proposal. Now, it is now therefore proposed to clarify with retrospective effect, with effect from 4/5, because that's the year when education cess was sort of introduced in the Income Tax Act. That surcharge and cess are not deductible. They are also covered in the definition of taxes which are not deductible. Therefore, in effect, they are not deductible in computing the taxable income, which is okay. I think that's not so illogical, except for the expectation that we have, or not. I mean, we sort of anticipate a lot of disputes will still continue. It's not going to die down so easily, because the first part, of course, which is going to be challenged, retrospective change. Well, it's not that the legislature doesn't have the right to make the retrospective change. They have, and particularly in those cases where there's a significant leakage of taxes for blatant, matters, they can. So here the question is going to be whether this matter stands the test, in which case the legislature has the power to legislate retrospectively, particularly in the context of a substantive provision, a provision which deals with taxation of calculation of taxable income. But two other concerns that we sort of anticipate is that, look, it's a retrospective amendment. Are we saying that therefore it is a possibility that there could be certain instances of reopening of assessments of all those people who claimed the deduction for this education cess, and their assessments never even started because, well, in our experience, all those cases where they were subjected to assessment, education cess was actually disallowed. But somebody who was not even subjected to any, assessment, now for that person, can there be a reopening of assessment for years going as far back as 2004-5? Not that too many people claim deduction for education cess in 4-5, but at least in last 3-4 years. That's question number one. Question number two. Those people who relied upon those high court judgments and said that, look, there are high courts, and not just one, several of them saying that education cess is deductible. Therefore, let's go ahead and claim this deduction, right? Are they going to be subjected to penalties on the basis of this retrospective clarification of law, penalties for concealment, or now the expression tends to be misreporting and underreporting? So can they be subjected to penalties? Because look, the point is they simply relied upon high court decisions. So is that also possible based upon a retrospective amendment or not, is something that we would be very interested in seeing, and this is something on which we expect the litigation to continue in some respect. Next slide, please. Now we'll talk about 43B. Now that's a provision that we know that, it's an exception to the general rule of mercantile basis, which means when you're computing your taxable income, there's a section towards the end 145 which says that you can compute your taxable income even on a mercantile basis. Expenses can be claimed as a deduction even on a mercantile basis. Expenses which are yet to be paid but they relate to this year can be claimed as a deduction. 43B says, hold on, not all expenses. One of them being interest, which you pay to banks, which you pay to NBFCs, non-deposit taking NBFCs, co-op banks, so on and so on. For that, the government has sort of given some kind of protection saying that, look, in the year in which you will pay that interest, then and then alone, in that year alone, we will allow you to claim a deduction for that interest. And of course, there's a little bit of an extension for the year till the time of filing of return. Now, the question was when you pay it, right? When you have actually made the payment. Now, in some cases, the assessors took a position that, look, you want us to pay. You're not saying pay in cash. The section 43B doesn't say that. So therefore, what we have done is we have discharged our liability through a constructively discharged our liability when we converted that outstanding interest payable also into a loan. So, that could be because of a CDR exercise or so on and so forth. But essentially, the person who had lent us the money has agreed that even the interest which is still outstanding and due will also be converted into a loan, right? And therefore, that will also an interest on top. So as a result, we have effectively paid it, right? And that was something which was plugged and passed through another set of amendments in 43B, right? By inserting 3 explanations that, look, well, conversion into another loan or borrowing will not be treated as payment, right? So no deduction will be allowed when you convert an outstanding interest into another loan or borrowing. Now, this thing still persisted because some of the court cases then, were about, fine, we have not converted it into loans or borrowing. We have converted it into a debenture. Now, debenture is a security. It's a security as against a loan or borrowing, right? It's a thing. So we have therefore discharged again constructively by converting the outstanding interest into debentures. And therefore, this should be treated at a different footing from conversion into loans and borrowings. Conversion into loans and borrowings, fine. It's not allowed by 43B as a deduction because it says so. But we are not converting into loans and borrowing. We are converting it into an instrument such as a debenture. It's different, right? And this was again something which was having its own tug of war between the revenue and taxpayer. And now the legislature has clarified through a proposal that, look, no, even if you have converted the outstanding interest payable into a debenture or any other instrument, it will not be treated as a deduction, because by converting it to a debenture or any such instrument where you are deferring the liability to pay, effectively what you're doing is you're not actually making a payment. What you're saying is, I will pay it in future, right? So when you pay it in future, then you claim a deduction. There's a CBDT circular to that effect. You can do that, right? But you will not be eligible to claim a deduction in the year in which you have done the conversion. That's what the proposal is about. But hang on, there could be some more dispute around it as well, because the proposal says that this proposal amendment applies when the conversion is into an instrument And that instrument is the one by virtue of which the liability to pay will be deferred. Now, let's pause here. What if the conversion is into an instrument which will not result in deferral of liability? And I'm here talking about something like, say, an equity share. Let me explain the difference that I'm saying. In case of a debenture, we know that debenture ultimately has to be paid back, right? But an equity share in a company, well, reality of the matter, fact of the matter is, once you issue an equity share to somebody, you never have to repay that money to that equity shareholder. You're not obligated to at all. It hardly remains a liability, right? And then that person actually becomes one of the shareholder, one of the part owner of the entity, right? And if at a future point of time, in distant future, there is a liquidation event which happens, that is when the person may get some money back. But we know about the going concern assumption. That means it's into an unforeseeable long distant future. And therefore, there is, and I know there could be instances of buybacks, there could be instances of capital reduction, but mind you, in equity, there's no commitment the company will make a buyback from you, or the company will do a capital reduction and return some money to you. There's no such commitment at all on part of the company. Equity shares, therefore, live on, and therefore, do they meet the test which has been inserted? And what's the test? Conversion into a debenture or other instrument by which the liability to pay is deferred to a future date. Is there a deferral of liability to a future date is the question when you convert the interest into equity shares. Maybe this is one of those instances where there is not. And if this is one of those instances, then I will ask the next question, that are we also going to stretch this to compulsorily convertible debenture? An ordinary debenture, which is not compulsorily convertible, that has to be repaid. But where a debenture is compulsorily convertible, that means it will never be repaid. It will also be converted into equity at a future point of time. So when an interest outstanding is converted into a compulsorily converted debenture, again, the same question rises. Is this one of those instruments by which the liability to pay is deferred to a future date, because there is no specific future date at all? It's long into distant future based upon going concern assumption. Next slide, please. Thank you. This is a small amendment and welcome amendment, naturally. Because of the pandemic situation, a lot of people who had their plans to start their own manufacturing operations and benefit from this lower tax rate regime under section 115BAB, which says that, look, if you're carrying out manufacturing operations subject to certain conditions, you'll be eligible for this amazing low income tax rate of 15% plus a charge in cess, effectively works out approximately 70%. They were supposed to achieve the commencement of manufacturing by the deadline of 31st of March 23. And now we know that, things are not as awesome as they used to be in past. Things are not so predictable as they used to be in past. There's a lot of uncertainty. I won't say dar ka mahal hai, but yes, given this, the legislature has considered it fit, and I think in all rationality and all logic, that this deadline should be extended by one more year, which means if you or any of your client are planning to get into a manufacturing business, then you have one more time to take it easy and start the business and still be eligible for the 15% tax rate, which is allowed under this low tax regime, and not be concerned about MAT provisions either. Next slide, please. This amendment is a pretty linear amendment, not too many controversies around it. There already exists a provision under the income tax law, which is section 248. Now, what does it talk about? What does it talk about? Normally, you file an appeal to the CITPL under section 246A against some action, right? There's an order with which you are aggrieved, and therefore you go to the CITPL. 248 is a bit of a variation from that. This deals with a completely different kind of a scenario. Imagine a scenario where you have a non-resident service provider, and as is often the case, the non-resident service provider say, look, boss, I don't know anything about Indian tax laws, but I'm a bit scared about it. So why don't we do one thing? Whatever is a tax which is applicable in India, you bear it, and these just gross up the whole amount, give me the net of tax amount, as simple as that. And let's agree contractually upon what will be the net of tax amount. Whatever is the tax on top of it, you bear it. In those kind of situations, the Indian resident is bearing this tax. And if that Indian resident feels that, look, I don't think the tax is even leviable to this transaction, right? I don't think that I need to even withhold any tax on this transaction. Then he has two choices: either to take that risk, not deduct any tax, not deposit any tax, simply make the payment and take his chances. Or the other possibility is he strives to achieve a degree of certainty about it, for which the prescribed procedure already there under Section 248 is that for the timing, just deposit that tax, the withholding tax, the TDS, with the government of India, and then approach the CIT appeals and request him that I think that no tax is actually required to be deducted, but the section says I should have done it. Now, please look at it. And if you also feel, sir, the Honorable CIT appeal that no tax is required to be deducted, please give me an order to that effect. I'll take a refund. Allow me to seek a refund. Now, in these kinds of cases, the CIT appeal would naturally, well, he'll look at the matter, but the situation is strangely that the assessing officer who's supposed to be looking at the matter would not have gone through the agreement, the written agreement which says it's a net of tax contract, and the agreement basis which the characterization is such that the transaction should not have any withholding tax in India. Now, in order to allow sort of the ear to be brought into loop, the provisions of Section 248, they have been, brought to a close. Instead, a new provision has been introduced in which now the application is to be made not to the CIT appeal, but instead to the assessing officer, saying the same thing, that, look, I had deposited the tax. I don't think any tax should have been deducted and deposited. And therefore, all I'm requesting is that please look at my case. And if you feel convinced, please give me an order to the effect that no tax was required to be deducted and therefore refund the tax to me. And for this, of course, the assessing officer is allowed all the powers to carry out inquiries, hearing, grant you a personal possibility of hearing, and so on and so forth. And then the good thing here, which is different from Section 248, is that there's a mandatory disposal time limitation which is given, which is of 6 months. The assessing officer has to pass his order one way or other within 6 months, saying that yes or no, I agree with your application. And if you feel that you have got an unfavorable order, the right with the assessee, the deductor, to approach the CIT appeal, it's granted under this provision. So this is a small amendment. Next slide, please. Thanks. Goodwill. There has been a lot of debate last year about the amendment which happened as regards the depreciability of goodwill. So we know it's a long history, which essentially is goodwill depreciable or not. At some stage, the Honorable Supreme Court in Smith Security said that it is, and a lot of courts and tribunals after that said that, look, the Honorable Supreme Court has said it, so it's depreciable, right? As simple as that. So goodwill became a depreciable asset in a very stark black and white manner, thanks to the Honorable Supreme Court's decision. While actually the governing provision, Section 32, which talks about intangible assets, it talks about trademark, brand name, copyright, licenses, or any other similar commercial or business right, business or commercial right of similar nature. Now, this last part is where the Honorable Supreme Court said that's where goodwill fits in. And as you can see, it's a pretty broad language. The revenue always felt that that's not the case. Goodwill doesn't fit in there. And last year, to that effect, the revenue sort of changed the law and said that no future goodwill, no future depreciation on goodwill, even if you have purchased the goodwill, no future depreciation on goodwill. And by future, I mean even in respect of goodwill which was purchased in past. Right? Now will not allow you to claim any depreciation in future. Now we know we have a block of asset concept, which means if you have a block of intangible assets, now goodwill will have to be taken up. And in order to take out that goodwill, Section 43 subsection 6 told us that how do you take it out? I think it was clause 2b. That this is how you calculate the amount of goodwill which is to be taken out, which is fundamentally speaking notional WDV of that goodwill, assuming it was only a second block. Calculate that and reduce it from the entire block of the intangibles that you have. Now here, because when that happens, Section 50 also gets triggered, because Section 50 says that what if the block, for instance, it gets empty because there is no other intangible. In that case, Section 50, both subsection 1 and subsection 2 actually use the expression transfer, that when an asset is transferred. Now, when goodwill related amendment was made in 2021, it never said that the goodwill is being transferred. It simply said, we know you still have the goodwill, you still possess the goodwill, you purchased it, you have it, you're not transferring it away. But still, we are asking you, because we have made this amendment that no depreciation on goodwill, we are asking you to subtract this, the value, the notional WDV value of the goodwill from the block of intangibles. So actually there is no transfer taking place, because of which section 50 could not get activated regarding this transaction, because section 50 requires a transfer to happen. It uses the word transfer both in subsection 1 and subsection 2, which was missing here, and therefore this year that sort of is clarified that, okay, fine, this adjustment to WDV which we referred to last year, that will now be deemed to be a transfer, which means that there are now possible instances where an STCG, STCL could arise because of these transactions. So this will therefore affect only one single year and no future years after that. This today's the Finance Act 2000, Finance Bill 2022's amendment will affect only one. Next slide, please. So we have come towards the last part of our discussion today. And yet, a lot of people think that, I don't have a film producer client, so it doesn't happen. And, you could be so wrong about this. This is an amendment which is not talked about at all by most of the people. And I still think that it has a potential to disturb a lot of people. So let's first of all talk about it. 285B, this section in past used to apply only to producers of cinematographic films, saying that, look, all those producers of cinematographic films, they have to compulsorily file a particular form 52A, which is a reporting requirement, in respect of any payment they are making to any person, which is in excess of 50,000 rupees. That's the old section, right? Cinematographic films. We don't have a lot of clients, we don't have employers, we are not ourselves engaged in production of cinematographic films. Unless you are rubbing shoulders with Karan Johar. But this has now been amended significantly, because now its scope has been expanded to cover not just the producers of cinematographic films, but also those who are engaged in event management. And the way I'm reading this section, it does not say only those people who are engaged in event management in relation to film production, nothing like that. I mean, it's just one of the several specified activities which have been listed out in the new section, which has substituted the old one. Which means if any of your clients, if any of your employers engages an event management company for hosting a dealers conference, for hosting an open house, for hosting an employee related event, right? It could even be an offsite. Then this event manager is the one which is going to be subjected to this reporting requirement. And event management is a pretty decently distributed business. Event managers tend to book tickets, tend to book hotels, tend to book celebrities to perform, and so on and so forth. And now all those event managers are the ones who are expected to make a filing with the as per the new prescribed forms and so on and so forth for any payment that they make in excess of 50,000. And mind you, it does not say any payment in excess of 50,000 made in cash. No, even if the payment is made through banking channels, still they're required to make this reporting. It applies even to those transactions which will anyway be subjected to TDS as well, and still they're required to make those filings. Similarly, those who are engaged in production of programs for TV, for OTT platforms, and then it uses wonderful expression, it says, or any other similar platform. Now, that's what sort of remarks me. What is any other similar platform? A platform which is similar to TV or OTT. Now, let me describe what my household looks like. We have a television. For whatever reason, we don't have a Tata Sky connection at all. And that television has Netflix and it has Amazon Prime. That's it, right? But the remote control to it has a hotkey for Netflix and it has a hotkey next to it for YouTube, right? And if you click YouTube again, the smart TV connects to YouTube. So is YouTube a similar platform to an OTT platform such as Netflix or Amazon Prime? And if YouTube is one of those similar platforms, then are we saying all the other similar social media TikTok clones are also similar platforms? Because then my question is going to be, anybody who's creating content for for a similar platform such as YouTube, who strikes me first? Taxmann, because right now we are also creating some content for YouTube right now, right? So if YouTube is a platform similar to OTT platforms, then any expenditure incurred by anybody who's even a YouTube influencer and a blog which is veg buffet and it's cooking a lot of delicious sumptuous dishes, and it is hiring some professional photographers, some professional marketing guys, social media marketing guys, and making some payment to them. All those people, all those youngsters who are creating content on their mobile phones, and then they are trying to figure out how to make it popular. They hire social media managers. Any of those, maybe not youngsters who will be paying 50,000 bucks, but if they have even once during the year to anybody, all of them, are they going to be exposed to a reporting requirement in respect of payments that are made, say even once during the year, or in parts, but as long as it aggregated exceeds 50,000 rupees, they are required to make a filing with the tax authorities in respect of whatever expenses they incurred, to whom did they pay, how did they pay, so on and so forth. It also goes on to say performing arts. What is performing arts? Any arts which is performed. There's no definition of art, right? It could extend to anything. But are we saying who are the artists who perform? The artists in the new world today who perform a lot are these stand-up comedians, right? So all these stand-up comedians, who are performing, if they have been engaged by an agency, next slide please, if they've been engaged by an agency which has sort of scheduled their programs, sold the tickets, all those people who are their fans, they come and listen, have a great laugh, and then the agency collects all the money and gives a part of the fee collections to the stand-up artist. They give some payment to the sound artist. They make some payment maybe to the restaurant where they are hosting the whole thing. Will they also be required to do these compliances? I have another question which I don't really understand. This section actually goes back to 1975. It's older than I am, right? And back then in 1975, the objective of this provision was, and this is what is given in the memorandum explaining the provisions of the finance bill. The object of the provision is to check inflation of expenditure of film producers and to enable income tax department to get information. Now, it sort of beats me, in order to get information, are we not doing enough as it is? We are subjecting a lot of transactions to TDS, and we have included the scope to, we have expanded the scope in every single, budget one after another. The TDS provisions are expanded year after year. Now we have a non-filers related provision as well. Also, our bank accounts are now seeded with PAN, with our Aadhars, and so on and so forth. The tax office is, with all due respect, collecting a lot of information. It already has a lot of information. Now, the same information will again be filed with it in the name of this filing, 25B filing. So we are probably duplicating. We are getting obsessed about collecting information. But really speaking, this will cause an additional burden, compliance burden, to event managers, to people who are producing for Netflix, for Indian versions of similar OTT platform. There's so many of them. There are so many people who are doing an excellent work over there. To stand-up comedians, which breaks my heart most. So that's, I believe, where my discussion comes to an end. But I would love to take up questions, if any.
Thank you, sir. That was one amazing session. Before some questions come in, any few words on the budget or the finance bill? Your views? Well,
candid views. Okay. A lot of the amendments were made essentially to cover all those unfavorable decisions which the revenue had got. And yes, there is no, and I'm only talking about from a tax perspective. I don't know anything about from the economician's perspective. Hell, my own economics are completely disturbed. But yes, from a tax perspective, I know it's always a very difficult hot seat for the finance minister to come up with a budget in any case. Plus, in this kind of a scenario where you are battling with how to manage hospital, all sort of expenses, which were completely unprecedented 2 years.
Correct.
Yes. So yes, it's been a bit of a challenge. I think it's a balancing up.
Great, sir. Great. Let me just go through the platform and see. I think we are good to go ahead, sir.
Great.
Great, sir.
Thank you so much. It was a pleasure. It was entirely a pleasure.
Thank you.
Yeah. Bye-bye.